Hello, everyone. Welcome, welcome, welcome. We are so happy to have you here. The Nest Egg Builder has just an absolutely wonderful team going to present today. Uh, the what we do, our mission statement is discover the power of smart investing and unlock the potential of building lasting wealth. By understanding money, mastering risk, and learning strategic investment approaches, you gain the confidence to make informed financial decisions. The Nest Egg Builder equips you with the knowledge to secure a prosperous future. And I bring that up because I just got a text from my nephew who's heavily invested in the stock market asking how am I doing? And I answered him with my real estate's doing really well. So thank you all for being here. And I love to pull a quote out for the team that's showing up or the speaker that's showing up. Today we have Justin Rupple and Gary Burns. And I love this quote. I think it's just for you. It's by Orison Sweet Martin. The golden rule of every businessman is this: put yourself in your customer's place, which is what he's going to talk to us about today and how the customer could benefit. I'm really excited about this. So today we have Gary Burns, who is going to introduce Justin. Gary has been in the insurance industry for the last 20 years. He's represented many businesses in research and development field. He has helped recover hundreds of thousands and millions of dollars. He's currently offering a presentation on the Champion Health Plan. This provides a tax advantage plan that provides a minimally essential contract for businesses, adds money to each employee's paycheck, and saves employers money on matching taxes and workers' comps in California. And you know, we love the matchmakers, so this would still be a matchmaking deal. And as you know, entrepreneurs love saving time and they love making money. So Gary, please introduce Justin and then the two of you take it away.
I think you just gave me a new job description. I'm going to be a matchmaker.
Yes, you are. You always have been. And look at what you're doing and Gary's also sits on the water board in not Calabasas,
Yes,
sorry.
Calabasas.
Yeah, in Calabasas, and he is serving his community. So thank you, Gary. Justin.
And there should be another gentleman, Ed Albrecht, that's looking to get on, but I haven't gotten back. So keep your eye on it, Peggy. He should be trying to come in.
Okay.
So, as many of you know, because you've heard our payroll tax reduction plan that Champion Health truly is, besides giving you great benefits that, as Peggy was explaining, are minimally essential. And it's not that they're minimally essential, it's that they operate as minimal essential programs so that if you don't have health benefits, they qualify as health benefits, and they sit next to workers' comp, next to major medical. Workers' comp's another part of it. So we may go, if there's time, I'll go into it a little bit later. And I see Mr. Eddie has gotten on. I texted him. I don't know if you got my text, but hopefully you did. So I'm glad to see you here. And so go ahead if you were going to say something, Stephen.
Oh, I'm sorry. I had a call that went late, so and I don't know if I got your text message, but I'm here now, so
Good. Glad to see you.
yeah.
So Justin and I met through another business associate, and for the last few years, we have been saving businesses and individuals huge amounts of taxes. Justin is an expert in understanding from at least a half a dozen, maybe a dozen different directions, how to save tax on your business, on the sale of property, and in all different directions that we work in. And I'm going to let Justin tell you the half a dozen things he does. And then we're going to focus today on the fact that if you sell an item like a business or a building, and it has 1 million, half a million, or $10 million of profit in it, Justin can keep it all in his pocket and you never get to see it. Actually, he can avoid you having to pay capital tax on it for the next 30 years, if ever. So, Justin, with that explanation and your great pictures, I'll hand it off to you.
Great. Thank you, Gary. Appreciate it. I know some of you I was able to meet before last time I was on. Appreciate the opportunity to be in front of you again. Thank you, Peggy, for hosting this and the invitation. It's great to be here. I'm Justin Rupple. My company's Elevated Tax Strategies. Gary and one of his associates, Brad Birch, who I know has been on this before, we collaborate together to bring sophisticated tax strategies to our business owners and real estate investor clients. So last time I was on, we talked a lot about cost segregation and depreciation, how that can be leveraged. Not going to go into that today. We kind of touched on the very end of our time, barely kind of scratched the surface. So we're going to do a bit of a deeper dive into, especially understanding a capital gain scenario. Sometimes it seems really simple and black and white, but even these last couple of weeks, I've had a couple really unique cases that have come across our plate where some of the strategies that we've been able to introduce to these clients were like the perfect solution they needed. And in both cases I'm thinking of in particular, they had never heard of these with things before, even though they relied on some really phenomenal CPAs or attorneys. So that's kind of where I'm going to go with this. One thing I'm going to try doing, if you remember last time I was with you, I had like a flip chart with me and I was drawing on it. I'm going to be a little more techy today, and I'm going to use a little like drawing thing that I can share on the screen with my iPad. And so, Peggy, there's going to be another Justin Rupple popping in the meeting, and it's just going to be like my iPad, which I'm using as a whiteboard. Okay.
Yes.
So once that pops up, you can let it in and I can get going with that. I'm just waiting for it to sign in real fast. All right, here we go. So the kind of situations that we're running into is, okay, we've got somebody, looking to sell their property, sell a building, sell their business. Here we go. Did you let me in?
You're not there to let
Oh, it's
in.
not coming in. Okay, my thing showed it connected, but it did not. So forgive me. I'm pulling up the email. And they're faced with the issue of having to pay significant capital gains. I had a woman reach out to me just a couple days, no, 2 weeks ago, and her situation, she's selling a second home. So this is, like a vacation home for them. It's not a rental or investment property. And being that it's not a rental investment property, it is not eligible for 1031 exchange. I'm sure many on this call know all about 1031 exchanges, where you can sell a property, roll those proceeds straight into another, and therefore avoid paying capital gains. Well, in this case, there is no 1031 exchange that she can leverage to this. So she's like, hey, my gain, once I sell this property, after my tax basis, which is what I originally paid for, it's deducted, I've got a $500,000 gain. What do I do about that? She's in, the property is in Oregon. And so an Oregon property, Oregon's about 10% state tax and federal is 20%. She's looking at about $150,000 in capital gains tax. It's a lot of tax that she doesn't want to have to pay, understandably. And so she's looking at, what do I do about this? What's a situation? What's a solution that I could bring to the table? So part of what we look at for capital gains planning is we're like, okay, let's consider what are our options of what you can do when it comes to any kind of significant capital gain. Now I think it's working, Peggy. Did it pop up? There we go. Okay. Right on. So we'll let this pop in. Perfect. And then you see two videos of me. I'm going to go ahead and
Yes.
see, is it going to let me do a whiteboard? Does it let me share?
You should be able to share.
Oh, okay. Usually on my iPad, it lets me do a whiteboard that I can draw on. And this time it's not pulling up. So that's why I was trying to see here. So here we go. Forgive me for my delay here, guys. This usually just lets me hit like a whiteboard and then I can draw on it.
The magic of technology. At least we're
Yeah,
all
I know.
here.
I actually did this last week for a meeting. If it's not going to work, then we can just talk about it and I won't draw it out because I'm not getting the whiteboard that it normally lets me pick, and then I can just use my pen and draw. And because of those issues,
And Peggy, I sent my own personal link to a couple of people who
all
can't
right,
seem to get through the Eventbrite program. So you may see
all right.
someone joining, might still say my name.
Here's what I'm gonna do. Because I
Watch
don't
all
want to waste
the
our time. That whiteboard thing's not working. Forget it. We'll just talk about it, and I can always, kind of if anyone wants to chat through and more specifically, I can draw things out. So you just use my fingers. Is that what you're saying, Gary? So basically, in her situation, we said, okay, you're selling this property, $500,000 gain. What are options? I said, okay, one is if you want the cash in your hands because you just want to spend it, remodel your house, use it to travel the world, do some vacationing, whatever. You got to pay the tax. If you want constructive receipt, that means cash in your hands. You got to pay the tax. There's no way around that. If someone tells you otherwise, they're encouraging you to commit tax fraud. I said, however, there's other things you can do. We look at capital gains deferral options. We look at offsetting options or investments that have tax benefits. So we look at a few different categories. So we lay this out there. Investments that have tax benefits, I told her, hey, if you want to take this 500,000 and in the same tax year, um, invest in oil and gas partnerships. There's solar credit investments you can make. There's certain real estate projects that you can invest in, like a fund, and they'll kick back deductions back to you. There's investments out there that have tax benefits, losses or deductions that get kicked back to you as an investor that can maybe offset some of this gain. That's one solution. So at least let her know those are things you can consider. She's like, well, we're not sure yet what we want to do with this money. Okay, no problem. Another option is a capital gains deferral strategy. And this is where most people aren't aware that these exist. So the 1031 exchange that many of you may know you can do, where you take a property, sell it, roll those funds into another, as long as you close within 180 days, no capital gains bill. Well, there's other capital gains deferral structures. Instead of 1031 is called 1031 exchange because it's section 1031 of the tax code. There's a section of the tax code called section 453. I briefly mentioned this last time I was on with you guys. Section 453 governs installment sale agreements. The most typical application of that is the very normal situation where you're selling something and rather than getting cash for it, you're given a note and then you get payments over time. Well, when you get a note, the government in Section 453 says we're not going to recognize that note value as your gain. Like if you get a note for, let's say you're selling a property for $1 million and someone says, and you decide to carry a note, someone doesn't actually give you $1 million. They might give you some kind of down payment, but you're given a note for $1 million. The government says we're not going to count that as a taxable gain this year. We're going to charge you tax as you get payments over time. That's a way of spreading out the gains or the taxes. Well, for a lot of sellers of businesses or real estate, they don't want to carry a note because carrying a note means risk. What if this buyer goes bankrupt? What if they fail to pay the debt? If I'm selling my business, what if they run the business into the ground and 2 years later can't keep paying off the note payments? There's risk there. Most sellers rather not do that. So they'd rather have someone come in and buy their property cash or buy their business cash or with financing. Whatever it is, I get cash I walk away with. So that's usually not an option. This tax deferral option is a third party that steps in and sets up a structure for your transaction and gives you a note in return. So the cash that comes from selling your business or selling your real estate gets captured in this structure that then allows you to reinvest that. So you get to decide, hey, this money that's being held in a kind of a tax deferred state, it gets held here, and now I can reinvest it in other things with zero capital gains bill due up front until I decide to take distributions. There's cash in my hand. So go back to what I mentioned, this particular person that called me, selling their vacation home, their second home, $500,000 gain. I said, in your scenario, I recommend the deferred sales trust. That's one of the Section 453 capital gains deferral structures. And so a deferred sales trust is they use a trust as the vehicle with a third party trustee. The key is there has to be a third party that steps in to hold these funds for you. That's the only way to have a legitimate tax deferral. So this third party steps in. It's a third party trustee. They set up this trust. And for this seller, we met with her and her husband, talked it all through. They said, let's do this. This is exactly what we need. This was the 11th hour. That decision was made 7 days before closing, which was last Friday, and they closed this Friday. And the team is scrambling, but they're pulling it together, working with their title company because their property has to be retiled into this new trust that just got created literally yesterday. And then the trust sells it. So the funds go into this trust. The trust
Mhm.
issues a note to the seller, which means the note means these funds are obligated to you. They belong to you. You can call them, you can claim them anytime you want. This is your money. But we as a third party, we're going to hold this for you. You don't owe any tax today. So that for this particular example, I'm saying she has a $500,000 gain. She closes her property this week. Zero taxes due. Before we met, it would have been $150,000 taxes due. So now that 500,000 is going to go into this trust, and then they have a wealth manager, financial advisor that's part of the trustee team. And this couple's meeting with them saying, hey, how do we want these funds invested? Now, instead of starting with 500,000 minus $150,000 tax bill, only 350 left, we're starting with the full 500,000 to invest in anything we want. So that's what's great about these deferral structures. Unlike 1031 exchange, where it has to go real estate to real estate, like kind, there's no like kind requirements. They can invest in stocks, which maybe if they hit rock bottom at some point soon, I don't know. I'm not here to give investment advice. It could be stock securities, but can also be other, they could still use this to buy a property, but without the time constraints. There's no requirement to identify within 45 days or close within 180. They can use these funds to acquire a business. They can use it to invest in a business or private equity or hard money lending. I mean, they can do all sorts of things with it. In other words, capitalize on the full $500,000 from the sale of their property without taking the tax hit. As time goes on, if they want to start taking distributions from this, they can just live off the growth, the interest or the accumulative wealth that these investments earn, or they can dip into that principal. As they dip into the principal and payments at their choice, they'll pay capital gains gradually. So this isn't eliminating the capital gains bill or avoiding it. This is deferring it. It's empowering the couple selling this home to be able to make the choice for themselves. When do we want to pay the tax? We're not ready to pay this tax. We want to keep letting this money work for us. So that's one very simple scenario. I'm talking with someone else who's selling their primary residence. That's their home that has a considerable gain. They're thinking it's a large house in the state of Washington. They're expecting it to sell for $11 million. Well, if you know your primary residence, if you're married, you get my house isn't that nice, but if your primary residence, if you're married, you get a $500,000 capital gains tax exemption if it's your home that you live in. So the first this guy bought his home for about 6 million. It might sell for 11. And we got connected with him just a few weeks ago. He's like, I don't want to pay the tax because I only get a $500,000 exemption. There's still $4.5 million worth of gain. That's a huge amount of tax. He's in state of Washington, 7% state of capital gains, 20% federal, 27% tax. It's a big tax bill. It's going to be roughly $1 million for this guy. So we're saying actually these deferral structures can also work for that. We can capture that the gain, and you can redeploy that in other investments. And he's thrilled because he knew he couldn't do 1031 with his primary residence unless he moves out and gets a renter in there for a year. Then it turns into investment property. Then he can. But he's like, I don't want this tied up in real estate. I want to use it for other things. So it becomes a great solution. There's another scenario that I had a call just this morning. I had a commercial real estate broker local to me who I gave a presentation much like this back in December. And that commercial broker scheduled a meeting with me out of the blue last week. And we had our chat this morning. And he said, hey, I've got a client. He owns a property in Hawaii and a property in the state of Washington, 2 commercial properties. He's looking at selling, and he wants to they're both very complicated, hard to manage. He's getting older. He's coming through some health problems. He doesn't want to leave these as burdens for his wife and children to deal with or manage. He wants to kind of liquidate them and invest in a number of smaller, probably single family homes, kind of more simple, whatever it is. That's his plans. His worry is that his gain on these 2 properties is going to be about $9 million. He can do 1031 exchange with these, but he's thinking of maybe going into a dozen or more smaller properties And to line all those up in 45 days to find 180 to close, it's going to be a nightmare. And when you get to those kind of time constraints, sometimes then you start making decisions that aren't the kind of decisions you'd make when you're not under the gun. So he's like, what else can he do? And so he said, hey, using instead of 1031, if you use the section 453 deferral structure, we have flexibility. And we talked that through. There's another one. There's the deferred sales trust I said a minute ago, which this woman selling a vacation home. I've worked with some small business owners selling their business for $1 million, use that structure. It's a great win for them. In this situation, there's a very similar structure called the secured structured sale. Don't worry about terms. It's also a 453 structure, just a little different. It uses an LLC instead of a trust, but accomplishes the same purpose. And so he can sell his two properties at different times. They're thinking one's going to sell in June and the other's going to sell in August. They're estimates. We can set up the structure. It can capture the proceeds from both of them as they sell, and then it will hold in this separate third party structure, and there's no capital gains due up front, and then he can take his time and find other properties. In this, he felt also constrained where I have to only invest the money in real estate because with 1031, you have to do that. Now the owner is excited that he might want to diversify. He might have some portion of these proceeds go into other kinds of securities and bonds, other kinds of investments. And a big portion will go to acquire more properties, but he can take his time over the next 6, 9, 12, 18 months to identify each property one at a time. And then the final kicker, this guy loves. The commercial broker said this guy loves depreciation. He loves it so much. That's why he wants to mostly invest in real estate. I said, when you do 1031, your tax basis, what you can depreciate diminishes because you inherit your tax basis from the previous property. In these deferral structures, the new property acquisitions, you get the full basis of the new purchases. So he can acquire with these tax deferred dollars, he can acquire new properties and get the full tax base of every single one. And he can have those deductions flow to him personally to offset other taxes. So you get the double dip of you get tax deferred dollars, but the full basis and depreciation of your new investments. And we can set the structure up to kick that tax bill down the road for 30 years plus. Plus, as this gentleman, like this particular scenario that I got encountered this morning, as that gentleman looks towards his legacy planning and estate planning for the next generation, this deferral structure can be brought into his family trust and therefore brought to his heirs with maintaining the deferral for decades. And so it outlives him, and that's a real win for him as well. And then any growth within that tax deferred structure, when it goes to the next generation, it itself gets a step up in basis through estate planning. And if you're not tracking with each component of that, just know all those things are phenomenal. I imagine a lot of you are. The key is when you're selling a business or you're selling real estate and there's capital gains, there are options that are worth being considered. Most people are only aware of 1031 exchanges, and I'm not putting that down. It's a phenomenal, simple strategy to roll money from one property to another and avoid paying taxes at that point. When you're in situations where 1031 is not going to work or going to be limiting, these structures, or selling a business where 1031 is just not even an option, these structures become phenomenal alternatives that really open doors and create opportunities that otherwise wouldn't be found. I'm last example talking to somebody not related to real estate. They run a food manufacturing, a consumer packaged good company that's scaling like crazy. This couple are the ones that started the company 10 years ago, with nothing, and their revenue is going to hit almost 50 million this year. Doing great. They got an investor coming in who's going to buy half the shares of the business at $1 million valuation. This couple is struck gold. They're so happy. It's the most they've never dealt with these kinds of numbers in their lives. Doing great. They're excited, but they have other investors, so they only own a smaller portion at this point. But their portion of the proceeds of that investor buying shares is going to be about $10 million, all gain. That's a big tax bill. They're in the state of Ohio, about 4% capital gains or 3.5%. So they're looking at about 24% federal state capital gains from 10 million. That's over $2 million in tax. And so we can use this structure with the secured structure sale, the 453, to capture that full 10 million they receive. That's probably going to happen third quarter this year. and they're going to keep, they're not selling their business, they're just selling a portion of their shares. We can capture that and they can have that reinvested. They have all sorts of ideas of investments they want to make with that money with zero tax bill to today. So great strategies, often unknown when you're dealing with even simple cases, someone selling their home for a good gain or a vacation rental or large business sales or acquisitions. So I'm going to pause there. A number of different things kind of throwing out there, different examples, but these are the kinds of things that we can help people with.
Yep. Great. Thank you very much, Justin. That was great. I have lots and lots and lots of questions. Does anyone else have any questions?
I would think Stephen has a question. I'll hold mine until the end.
I don't know if he does, but
I put someone on the spot. Let him process.
So, I mean, I do have. So, Justin, nice seeing you again.
Thank you.
I'm sorry, I am a CPA, so I'm winding up this first round of tax, so I'm a
Oh,
little bit like
thanks for
fried
carving
right
out a
now.
little space to be with us.
I know. Well,
Yeah.
no, this year is nothing like it has been in the past, but so I do have a question about the 453s and
Yeah.
these specific trusts that you guys are doing. I think the last time we spoke, you work with a trustee and the trustee, like what's the rate on these? When you set these up, like is it based on the revenue, the amount that's coming into the trust? Is that how they do it?
You talking
Or
about their fee structure? Is that what you're
yeah, yeah.
okay, yeah, great question. So like anything, there's going to be some kind of fee structure for any kind of strategy where the key is any kinds of things of this sophistication, work with the team that is dedicated, that's been doing this for decades. So the deferred sales trust specifically, my DST team, they're based in Southern California. They've been doing this for over 20 years. They work with one of the there's only 13 DST trustees in the US. So one of them runs that organization. Um, there is a bit of a graduated fee structure based on the kind of different levels of the dollar amount of the value of kind of the proceeds that come into the structure. On the lower value end, which means higher fee, it's around 2.5% of the gross sales price, and that diminishes a bit as the numbers get very high. But that's kind of the starting place. The secured structured sale, there's a little more complexity, but also far more flexible long term. That one, it's set up a little differently, but it's around 4 to 5%. So not nothing for sure, but also significantly different than paying the tax.
And what about an annual fee?
Um, that's a great question as well. In the model of the deferred sales trust is a little different in that part of their team is the financial advisor or investment advisor that oversees those funds on your behalf that you work with. So they have a built-in assets under management fee that is around 1%. That also diminishes as the dollar amount gets very high, but it's around 1% annually to cover everything. That a secured structure sale, why that's preferable for larger dollar amounts and when someone's a more savvy investor, is that the team that does the structure, they manage the structure, not the investments. You bring your own investment advisor, your own financial advisor, whoever you personally have trust or relationship with, or who the client does, to gets appointed over that. So the structure annually is a much smaller. It's a very small percentage of the gains of the structure, but it usually average around $4 to $10,000 a year for all the compliance around the structure. And then whoever you point as your financial advisor over those funds, they might have their own fee structure, whether they're flat fee based or they're assets under management fee based or percentage, whatever that is. So whenever we have a client exploring these, we make sure we walk through all those details because they got to understand what's the cost, what's the benefit, is this the path I want to go?
Anything else, Stephen?
So only Justin, on the deferred sales trust, is that a requirement? You've got to use their financial manager, their
Uh,
financial advisor.
yes and no. It's under their kind of brokerage account and all that. So they do have a pathway that if somebody has their own financial advisor that they really want to be over this, that financial advisor could go through a process of kind of coming up under their umbrella to manage that on your behalf. Not every financial advisor may want to do that. I'm just saying they have a pathway for that. On other than that, because it's still within their system, the secured structure sale, they'll work with whoever you have to bring the funds into their brokerage account, whether they're with Raymond James or Fidelity or, whatever, whoever, is your investment advisor.
Okay, and exchange brokers have been using 453s for umpteen thousand years, however long it's been in
Yeah,
place.
actually, 453 has been in the tax code for about more than twice as long as 1031 has been.
Yeah, actually, yes, it has been.
It is a long-standing, stable part of the tax code, your ability to use installment notes as a way to defer capital gains.
Hence the number 453 as opposed to
It's a lower number.
1031. Like
One way to
that,
look at it, yes.
So
like that.
I've learned a few things today. I didn't know that the depreciation came over from the 1031 property. That was something new, and I've listened to this over and over again. And now I understand that these numbers.
Yeah, whatever your tax basis was in your first property, that goes into the second. So all
Oh,
the
yeah.
value, you don't get to depreciate that at 1031. And so with these structures, you get to do that. And so it's a way to really capitalize on both the deferral, but also the depreciation of your new investments.
And I've heard you do this many times, Justin, and I've talked to lots of people about it. And there's a couple of things that I always say. From a lot of people I hear, oh, well, I already heard that seminar. No, you didn't. You got to listen 6, 10, 12 times
Right.
before you really hear it all.
Hey, I mean, I've
And
heard it shared so many times. It took a while for me to get to where I felt comfortable talking it through. I've, those that do this for a living, much before I learned about it for over 20 years, I listened to them talk about it in so many different scenarios. Yeah, it's very nuanced and complex. All these things are,
Okay.
but can be beneficial.
So
and
I now have $500,000 sitting in this account, this 453, but I want to take this money and I want to use it as a down payment on a self-storage. That's
Yeah.
1.5 million. So I
Mhm.
could get a loan for the million and have the 500,000.
Yes.
And that account is now closed because I use it as a down payment. I didn't take the capital gain on it. Somebody else gets to do that. They get to receive all the payments. So we're just transferring.
Do you mind? Let me walk through how that would work. Does that sound good?
Yes.
Okay, because that's a great scenario that we often
Betcha,
encounter.
babe, because I want
Yeah,
my money working for me. If you start to
absolutely.
see that huge amount of
Yes,
money.
so you can, in either one of these deferral structures I'm describing, the 453 kind of concept is we have this kind of third-party structure that gets set up that your tax deferred dollars are sitting in. It's owed to you, so you can have that money anytime you want, but you want it to work for you, like Peggy said. So yes, you can have the financial advisor, whether yours or the team's investing it in the markets or whatever you want, but then you find a storage facility you want to buy. And you're like, forget, we know what can happen to the stock market if you've looked at any headlines the last week. I want, storage unit's not going to have that kind of volatility. So you find one for 1.5 million and you want to take this 500,000 and make it your down payment. So here's what you wouldn't do in that scenario with this tax deferral strategy. You wouldn't withdraw those funds and put it in, because that's getting your hands on the money. That would be considered constructive receipt, and tax bills due. This deferral structure is its own entity separate from you. And so you would go and buy this storage unit. You'd create a new LLC to acquire the storage unit. You personally, let's say it's you, Peggy, you would be the general partner managing this property, but you're not coming in with any capital. This deferred sales trust or the secured structure sale, which uses an LLC, either way, this structure comes in as the limited partner, putting your capital as an investment into it. Your 500,000 of tax deferred dollars, it comes in to put your investment into that. And then but you're in control now of this
The
LLC.
seller has it. I'm buying this from the seller. The seller now owns that note.
Yes, so it puts the money into the LLC, and then the LLC gives the 500,000
Okay.
to buy the property. Yes, exactly right. So you would structure that new LLC partnership where your deferral structure gets some kind of simple minimum rate of return, as you're collecting rents or whatever you're doing, or monthly payments from the storage facility. You would because this deferral structure that had your $500,000, it no longer has its 500,000 because it's in the storage unit, but it has the obligation of 500,000 to you. And so at some point, when you liquidate or sell that storage, the money can come back to it. But for now, it's deployed into this investment. And then, but it has no need for depreciation or deductions. But you might want that,
Well, yeah, I'm gonna do a cost seg.
as you should. And so in this LLC that you are personally in partnership with your deferral, you would allocate
Not
all.
in partnership with the deferral. The deferral is gone. The
No,
seller
well,
has.
that's where having the diagram would help. The deferral's not actually gone. The
No,
deferral,
it's gone for me. It's now the responsibility of the you and the seller are now partners. I'm no longer a partner in that. He accepted that as the down payment.
but the deferral of your original tax, whatever you sold that got you $500,000,
Hmm.
this deferral, that deferral still exists. So that doesn't disappear. That is going to invest your $500,000 of tax deferred dollars into this new property with you. And so drawing it out could be helpful, because if you see it as a bank account that you took the money out and put it over here, well, this bank account goes away. It's not a bank account. It's a structure that obligated to give you $500,000.
Right,
It's
I
a,
understand that.
it's a legal structure, and I think Justin said it before. It has to continue to exist, or else
It
you can't
does.
have constructive use of the funds.
All of it still exists. It just no longer exists with me. It exists with the seller now. So their partnership, the partners have changed on it. The seller accepted that
Oh, I get what you're
cash
saying.
flow as the
Right.
down payment.
Yes, but that wasn't, the seller doesn't take on the capital gains deferral because they're not taking your deferral structure. The $500,000 is invested from your deferral structure into the property. So the dollars
Right.
have gone to that seller, but your this LLC that is the that now owns the property is a partnership between you as the general partner and your deferral structure as a limited partner. Stephen, I see you nodding. You seem like you're tracking with me. Um, and so, but it's conceptually, I'm saying, hey, I don't personally have this $500,000. My deferral structure has the 500,000. If I had it, I'd have to pay the tax. It's deferred in this structure, but I want to buy that storage unit over there. I don't have $500,000 to invest, but I have a deferral structure that does.
I have a
Now let me
note.
go in partnership with my deferral structure to buy the property. So now me and the deferral structure own the property. I'm in control though as the general partner. It's a limited partner. It can't make any decisions or do anything. It just gets some kind of rate of return back. I get all the deductions. I manage the property. I own it now through this LLC partnership. So basically, we create a secondary entity that owns the property. Um, and if anybody's looking to do that, we can help them, brainstorm how to structure that. Ted, I saw a hand go
So
up.
are the payments going to the seller?
No, the seller's not carrying any note. The seller's bought you. Did you take, if you took
The
financing?
seller took my note, my 453.
No, that's not how it could work. The seller can't take that. You're just buying the property from them with
No,
the,
I'm using that as a down payment. If I did a carryback from, if I didn't put it with you guys and I just did a 453, right, as a carryback,
yeah.
that person that I'm carrying back from wrote a note to me saying that they were going to pay me. I am going to transfer that note over to somebody else. So now the buyer that from whom I sold
Yeah.
is now going to be paying that
So
seller.
you're describing the scenario of a typical 453 when you're doing carryback notes. That absolutely works that way. But
Okay,
that's a different application of
but
it.
that's what I wanted to find out.
Structure. Got it.
Those little innuendos make a big
Yep.
difference, particularly if I now have to pay a capital gain on that $500,000
Yeah. In the scenario I'm describing, you would not have to pay it at that point. Absolutely not. It would
because I
continue.
still have control over it and I'm just making payments to the seller and paying the capital gain as I'm paying the note.
Yeah, you actually wouldn't pay any capital gain because that 500,000 is still going to be invested in the property, and it wouldn't be until you eventually sold that property that there could be a capital gains event. Then we could even
And that's
continue.
what I was going to ask. So when you sell that property, you can capture the capital gains in another deferred sales trust.
Yeah.
But does
Uh,
the original sales trust get back their money?
uh, yes, it would because it came in as a limited partner then and made that investment. But that money is at your discretion to then reinvest wherever you want it because it's still yours. I want to make sure we don't overlook. Ted, you raised your hand a minute ago, and you were going to say
This
something.
was just a real, let's say, an attempt to clarify Peggy's understanding, which I would clarify this way. Yeah, you got a complicated structure, which means you got to have a good accountant on your team.
Yes, absolutely.
And we have a good accountant on this call.
And there's different ways to set up these kinds of structures, but that's exactly the point. We have a tax deferral structure, but we want to acquire another piece of property or a business, because I've had people do the same thing Peggy's describing, but in acquiring a business. Well, how do I use my tax deferred dollars and redeploy them? Well, I do it by creating an additional partnership of between me and my deferral to then acquire that business or acquire that property or whatever that might
But
be.
how are you paying them?
It sounds like the easy way to screw up your tax deferral is crappy accounting.
Yes.
Well, right now I haven't figured out how I'm paying the seller for the property if I still have the $500,000 453.
Peggy, the point is you don't. If you did, you'd pay tax.
Yeah, the whole point, it's a third party structure that gets set up, but
Yes,
it
but
still
I'm
exists.
using that money for a down payment on another property.
You're
Yes.
partnering with the entity. You're not using the down payment. The entity is partnering with you.
The entities you partner with are the ones who actually make the transactions. You don't yourself, because if you
How does the
did,
seller
you
get
pay
paid?
tax.
Well, the 500,000 comes out of the deferred sales trust. It now has zero in it, but it has a note because it owns 1/3 of your,
LLC.
of the.
It owns 1/3 of the LLC, which owns
Okay,
the
fine.
storage unit.
I got it. Thank you very much.
Exactly. So
Storage unit. I was trying to
yeah.
think of what we were actually
So it made
buying.
an investment. It didn't spend the money. It made an investment.
So
And yeah.
Got
wanted-
it, got it.
I wanted to add a couple other things. There's something else I heard today, Justin, that you can take some of this money, and I think you have said this before, and slowly pay tax on it on much lower taxable income, and also possibly not affect your IRMA if you're on Social Security. So that was interesting, and I hadn't actually recognized that
Yeah,
before.
I've seen situations where, you sell a business, let's say, or a property, and you use this deferral structure, and then you gradually take distribution. And maybe you don't need all the cash real quickly, because you haven't invested, it's your retirement, whatever it might be. Well, if you federal capital gains gets up to 20%, but below, I think if you're married, it's around 600,000 of AGI, it goes to 15%. So you can manage that by, hey, if there's years that your income might be, 100,000 or so, you might take a bigger portion at a lower tax rate. So it's a way that you could be in control of that, where you can gradually liquidate this deferral structure by getting distributions and apply them to years where you were in lower tax brackets. And so that's a way to, effectively kind of have a rate arbitrage there, which means saving money. Some have no desire for that. They'd rather this money stay deferred for long term and capitalize on its investments and whatever that might be. So yeah, there's opportunities there. Also, in a situation like the guy selling his home for $11 million, his tax base is about 6 million. His exemption for capital gains is only 500,000. That's all that's exempt from capital gains. He can get that distributed to him right away as with zero tax impact, because we're only going to put in the structure the taxable gain portion. So in that scenario, it's about 4.5 million that's going to be taxable. We'll tie that in the structure to defer it. The other can just be kicked right to him directly as a distribution because there's no tax on it, because his basis covers that. So it's another way where there's flexibility of like, hey, whatever part's not taxable, you can get that cash in your hands because that doesn't have any tax impact. We're just using this to defer
Yeah,
whatever.
the capital gain.
Yeah.
Yes, I have one more because we work with passive investors. So you're people that, especially somebody that's already in real estate, taking on a job of buying a bunch of single family when he's older, it's probably not the best scenario for him, but investing passively where he doesn't have to do anything and his money's and that money's used for his portion and he gets cost segregation on top of that.
Mm-hmm.
And he doesn't have to do any management and he could be in it for a lifetime. And his
Yeah.
family could also inherit that lifetime cash flow. That's another scenario. Now that I understand how that works, that would be really perfect for somebody that really wanted to retire out of real estate, but still wanted to have the advantages of real estate.
No, I'm absolutely with you.
You and I should have a conversation.
Yeah, no, absolutely. I didn't get to meet the owner, the gentleman who's actually going to be making those decisions. I met his broker, his
Of course.
real estate broker, who's the one that asked me, "Are there strategies for this?" But I'm with you that that would be um, moving to more of a passive investment position.
Well,
would be
when you get older, do you want to be doing all that work?
Yeah,
Let
well,
me
that's
tell you,
exactly, yeah.
you don't know yet. You haven't crossed that line.
No, getting older and doing all that work keeps you young. That's the whole point. Not to
Well,
see.
but
Yeah, but
Not,
sometimes it's more a matter of priorities. You want to spend more time with family and things like that, and that's completely understandable. So I get you, Peggy. That's a good point.
Therese, do you have any questions you might like to ask?
This was fascinating. It's my first call. I'm learning a lot, definitely. And as it was mentioned, I'll probably have to listen to this a few times to really comprehend everything, but it's really fascinating. I learned a lot, definitely.
Great, thank you. Vincent, might you have something you'd like to ask? No, you're just showing your picture. Or Alan?
he is
How
my
about you,
friend. He is
Alan?
my friend of 40 years. I'm not sure he has a microphone he can talk from, so
Okay.
he may not.
Alan, might you have something?
Hey, this is all great. I've met Ted before on another call, maybe Advanta or something, but good to see you again. This is a really good structure. Is it same DST, same initials as Delaware
So
Statutory
that
Trust?
that can be confusing and not to be confused with that. So yeah, Delaware
Yeah,
Statutory
no.
Trust, the other DST is a different thing, still related to real estate. So yeah, you can do a 1031 in, that's what a Delaware Statutory
Yeah.
Trust is, where you can move money from a real estate investment to a 1031, and that allows you through the DST invest in like a real estate fund more passively. So I know people that do that. It's great. The deferred sales trust I'm describing, even though it's the same initials, um,
Yeah.
similarly is a capital gain strategy, but it's for any kind of capital gains event. In fact, I'm talking to someone right now that's thinking of liquidating cryptocurrency holdings,
Mm,
which would be a major capital gains event to
mhm.
highly appreciated crypto. And we can use one of these structures to capture those proceeds, and then he can reinvest them without paying any capital gains bill today. So these structures can be used for virtually any capital gains event. The only thing you can't use Section 453 for is the sale of publicly traded stock. For whatever reason, that's part of the tax code, so we can't use it for, if you got a ton of money in Apple or something and you want to liquidate it, you're out of luck with one of these structures.
And
But
Alan, it's
Yeah.
only good for 6 months out of the year during daylight savings time. Laugh, laugh, LOL.
yeah.
Sorry.
Yeah,
Anyway,
we got Eastern Standard Time where I'm at, so that one didn't hit at all.
okay,
Um,
sorry. Well, daylight
so I,
savings time applies across the country. And I was going to tell Therese, all of these nest egg builders are on YouTube. You can go back and listen for the last 5 years.
Oh
So
my goodness.
you
Yeah,
can,
give me some homework. I'm definitely going to watch the recording of this though,
that's,
because it was really fascinating and I might have people interested, in the future for this. So definitely, it's really a great topic, Peggy. Thanks for bringing this to me.
Oh, you're welcome. So
and
yeah.
Chris, Kathy,
My question for Justin is, I might have missed your intro as far as who who you're working for, how you participate in these. Are you one of those 13 companies that you named?
No, great question, Alan. So my company, Elevated Tax Strategies, we're a small business that simply provides basically tax strategy consulting for business owners and real estate investors. That's what we do. We just do this kind of stuff, educating, consulting. Here, let's consider you're selling a business, a property, or you're let's consider here's options. You're running a profitable business. Here's tax reduction strategies. There's lots of things that we bring to the table. But effectively, just to be really clear, the specialists that provide the services around each one of these strategies, they run their own boutique firms that specialize in that one thing and that one thing only, and been doing it for decades. So we partner with them. So like my DST team, technically it's a separate team. They're not employed by me. If you want to look into the deferred sales trust, or you have a client that does, we'd get on a call together, talk it through. If it seems like it's worth exploring for them, they like the concept, at least generally, I'll bring my specialists in, then work through it. I did that with that woman selling the vacation home just a couple weeks ago. They're moving forward with it. I don't charge anything. The DST team has their fee structure. They compensate me a portion of their fee structure. So I'm effectively brokering the specialty tax services. And so kind of pooling together a variety of specialists that they're all kind of siloed from one another. Unfortunately, there's very few people kind of trying to bring this all together to help people consider, that's what Gary and I love doing. And so we got all these different specialists. They have fees, they compensate us. We have kind of revenue share agreements with them. So we get covered on the back end.
All right, well, that's great. I've had people do 1031s into property that I own. So I've done it from that side. I've not 1031 into anything. But I do have some people that have money that's kind of like you. Somebody sold and they're going to pay some tax on it, and they'd like to 1031 into some land that I own. So that might be an opportunity where I could talk to somebody like you, and you may have those people that want to fill that bill. So that'd be great.
Yeah. And I'd say for you, Alan, or anybody, Teresa, you'd mentioned if you have a client or someone you're working with that, they might be, approaching a situation where any of this could be relevant, please feel by all means, let's plan a call. Gary is probably the easiest point of contact to kind of connect with, and he can learn a little bit about the situation, and then he can coordinate us all getting on a call, and I can join. We welcome you to be part of that if you feel comfortable because you have a good relationship with whoever the person is. You'll learn through it too. And that first part there's no charges for that. That's just, hey, let's talk through different strategies, see what might be a good fit. If something does seem like it's a good fit for the scenario, we'll bring the specialist to the table next
You
to
brought up another question.
go ahead.
So if a client, let's say the lady with 150,000, it's not a lot, but it's enough to do, like, be a lender. Now, could she say, I want to be a lender and have that account grow? Could she say where that money could be? Because it's still going to be in the account, but 100,000, let's say, is going to be lent out at 10 or 12%.
Yeah, so some hard money lending she's wanting to do.
Yeah, hard enough.
Yeah, yes, you can.
Okay. Oh, cool. That's
Right.
good.
So there's ways to structure that and set that up so that it protects your deferral, but you can still access it for that purpose. Yeah.
Right. So now you'll owe more taxes, but yeah.
I put my phone number in the chat, so I
Okay.
am trying to do what Justin has said. I brought Justin on this call because, I hear all the time from business owners, I need a good CPA. I don't know why they all say that. Sorry, Stephen, but they do say that to me. So with all of us meeting other people, most of the time I find that unless they're a very sophisticated business owner, they don't know anything about this. They have never heard about all the different scenarios that we talk about on this group. And so I am bringing Justin together. We have an attorney that restructures businesses. We're trying to bring a whole group together so that anybody that we run into or that you refer for our Champion Health Plan can see the full aspect of what it is that's possible. And even if it doesn't apply to them or one part applies to them, they probably play golf on the weekend or know somebody else and they refer us, especially when they get a 50, 60, 100,000 or $500,000 check from one of our programs. Then they really refer people because they want to brag about the money that they got back and they haven't paid. So it's really wonderful when you help people in the way that we're doing also. It really feels good. So we
Yeah.
appreciate knowing all of you and we're here to help.
Kathy, you have any questions or any thoughts?
Oh, you were asking about the private lending thing, but then you said, but then you'd have to pay more taxes, but you wouldn't have to pay, those taxes would be deferred too, because it would be within the
Right.
sales trust,
So,
right?
do you mind if I speak to that really fast before we close?
Nope, go right ahead.
So the way these deferral structures set up, you then can just diverse the funds into other investments. Could be private hard money lending or securities or real estate or whatever. There's going to be some kind of cash flow back because you're getting, interest paid on it, or it's, invested in something that's dividend paying or whatever it might be. So then you have options to where that can be kind of recapitalized and reinvested, or it can be distributed to you. Technically, this structure owes you this money in the form of a note that you personally have. So they'll kick that money out to you as interest on the note. So yes, it's true that when you, because you might need money off of it, you might need some of the income off of it, and living off of that. That's totally fine. That comes to you as income. Absolutely, that is taxed. So when you get the money in your hands, yes, it is taxable. So again, I always tell people we're not bringing tax avoidance schemes. That's going to get you in jail. You know, these are tax deferral. It basically lets you maximize your investments. So yes, eventually things will be taxed, but it lets you make the most of these dollars until you want it in your hands to be taxed.
Somebody has to pay those people in Congress. Okay, everyone, any last minute question? Otherwise, we're gonna, yes, Marcy.
Yeah, you said stocks are outre, but what about antiques, art, jewelry, those kinds of assets? Are they included in this?
Yes, absolutely. So now, of course,
Okay.
the money in this can be invested in stocks, but you can't use it to defer the gain from stocks. But any kind of highly appreciated asset. So if it's something of considerable value that there's a gain on it, if you were to sell it, people have sold yachts and boats with these structures, things like that. So that could be art.
Thank you.
Thank you, everyone, very much for being here. Really appreciate it. We hope you come back again, both of you.
All right. Thank you, everyone. Thanks for having me today.